Okay, we're going to look at some problems from chapter 5. Specifically, let's start with exercise 5.3, and I'll read it to you and then we'll do the solution. So assume that on September 1, Office Depot had an inventory that included a variety of calculators. The company uses a perpetual inventory system. During September, these transactions occurred. So we've got about 7 transactions that we need to record. And it basically says just prepare the journal entries. So on September 6th, they purchased calculators from Drago Company at a cost of $1,650 on account net 30. So we're obviously going to have some debits and credits. Debit, credit. They purchased inventory for resale. So we're going to debit the asset account called inventory. And again, this is exercise E5.3, just so we can keep track of it. So we're going to debit inventory for $1,650. It is a payment on account. A/P, accounts payable. On September 9th, they paid freight of $50 on calculators purchased from Drago. So when they paid for the freight, it's part of inventory. So now we're going to debit inventory again for the freight charges, and that was $50. And they said they paid it, so we can assume that they credited cash. On September 10th, returned calculators to Drago for $66 credit because they did not meet specifications. So they returned some of the inventory. So they don't owe $66 and the inventory is going to go down. So we're going to debit accounts payable for $66 and we're going to credit inventory for $66 as well. On the 12th, they sold calculators costing $520 for $690. So they sold, the sales was $690. The cost was $520 on account net 30. So we're going to record the sale and the cost of the sale under the matching principle. Let me erase some of this. So we're going to record the sales as accounts receivable. For $690, credit sales revenue for $690, but we also need to record the cost of the sales. So we have debit to the cost of goods sold for the $520, and it comes out of inventory for $520. On the 14th, they granted credit of $45 to Fryer Bookstore for the return of one calculator that was not ordered. Calculator cost $34. So they need to reduce some of the revenue, so it's sales, returns, and allowances, and they need to put it back in inventory. So we're going to have a debit to sales, returns, and allowances for the $45. And we're going to remove the accounts receivable A/R for $45. And they also need to do what? Put it back in inventory, right? So they're going to debit inventory with $34 and credit cost of goods sold, CGS, for $34. And then lastly, they sold calculators costing $570 for $760 to Heasley Card Corp. So they need to record the sale, and they also need to do what? Record the cost of the sale. So our last transaction, going to debit accounts receivable, A/R, was 760. Sales revenue 760, and then the cost of the sale, CGS, cost of goods sold, 570, and a credit to inventory comes out of inventory, the asset, for 570. Okay, so that was exercise 5-3. Next exercise we're going to look at is exercise 9. Exercise 9, and let's read it. It says, in its income statement for the year ended December 31st, 2022, Darren Company reported the following condensed data. So there's a bunch of accounts here. It goes on to say, A, prepare a multi-step income statement. B, calculate the profit margin and gross profit rate. So we want to prepare an income statement, a multi-step income statement. This is for Darren Company. There's debits and credits here, right? Darren Company. This is an income statement. This is the title, right? For the year ended 12/31/22. Remember, the title tells the reader of the financial statement the name of the company, which financial statement they're looking at, and lastly, what the time period here is. So we have sales revenue. Of $2,210,000. I'm going to drop the zeros. Less discounts, 160. So we have net sales of $2,050. Cost of goods sold, CGS, 987. So we have gross profit of 1,063. We have some operating expenses. We have salaries of 465. We have depreciation of 310. We have utilities of 110. Total operating expenses, running out of room, I apologize, of 885. 1,063 minus 885 equals net income, NI 17. This is income, pardon me, income from operations. It's income from operations because we don't have any income tax expense here to account for. So it is simply income from operations. Next part of this problem says calculate gross profit and profit margin. Okay, there is more here. I'm sorry, apologize. So we have income from operations of 178. $178,000 is income from operations. And we have some interest revenue of 83.5. I'm sorry, that's 65,000. We have loss on sale of assets of 83.5. So this is the other stuff, right? Other revenue and expense. That's what this category here is. And we have interest expense of $71,000. So we have income before taxes. And this is 154.5. Income before operation. Income before income tax, right? Income from operations minus the other 154.5. Income before income tax is $88,500. The income tax expense is $25,000. Net income $63,500. Okay. Again, if you want to see the full printed out, a lot neater solution, please visit Sakai and you can see the printout there. The next item it's asking us for here is to calculate the profit margin and the gross profit rate. The profit margin is going to be what? Net income divided by net sales. In this case, it's 63.5 divided by net sales, 2,050,000. This is 3%. And the gross profit rate, that's going to be gross profit divided by net sales. Gross profit from the multi-step income statement that you just prepared, 1,063,000. Divided by the net sales of 2,050,000. This is going to be 52%. 52%. That's exercise 5-9. And let's look at problem 5-2A. Of course, the problems tend to be a little bit more extensive, asking for a lot more information. Powell Warehouse distributes hardback books to retail stores and extends credits terms 210 net 30 to its customers. 2% discount if paid within 10 days. Otherwise, its entire amount is due in 30 days. During the month of June, the following merchandising transactions occurred. So we're going to record a bunch of transactions, right? Debit, credit. Powell merchandise purchase books on account, 1,040, including freight from Caitlin Purchases, publishers, 210, net 30. So we're going to have the prices 1,040. So we're going to debit inventory, 1,040. Credit accounts payable, A/P, 1,040. On June the 3rd, they sold books. So when you think sold, they need to record two entries, right? Record the sale and record the cost of the sale. Sold books on account to Garfinkel Bookstore for $1,200. The cost of the merchandise was $720. So let's record the sale. Accounts receivable A/R for $1,200. Credit sales revenue, $1,200. But at the same time, right, this is 6/1, this is 6/3. They need to record the cost of the sale. So they're going to debit cost of goods sold, 720. Credit inventory, 720. On the 6th, 6/6. Received a $40 credit for books returned to the publisher. So they're returning something. They're going to reduce the amount of money that they owe those people, reduce the accounts payable by $40 and take it out of inventory. $40. On the 9th, on 6/9, paid the Caitlin publishers in full. So they paid the publisher in full. Looking at my solution for 6/9, I'm a little concerned here. 6/9, paid publishers in full. So they're going to remove the accounts payable because they had what? They had 1,040 that they owed them, but they returned $40. So they only owe them $1,000 now. So they're going to reduce accounts payable by the $1,000. But they also get what? They're getting a discount because they're making the payment early because it's the 9th. They purchased it on the 1st, 210 net 30. They paid it within the 10-day period. So they're going to get a 2% discount. $1,000 times 2% is $20. So we're going to credit inventory for the $20 because it reduces the cost of my product, doesn't it? And then they're going to pay them with what? They're going to pay them with cash. So $1,000 minus the $20 discount, they only owe them cash of $980. That's what occurred on 6/9. 6/15, received payment in full from Garfunkel Bookstore. So they originally sold it for $1,200. So they're going to receive the cash. This is what, 6/15. They received cash of the entire amount, $1,200. And they're going to reduce their accounts receivable by $1,200 as well. Go to the 17th. Sold books on account to Bell Tower for $1,200. The total cost of the merchandise was $730. So again, we need to record the sale and the cost of the sale. Debit accounts receivable, A/R, for the $1,200. Credit sales revenue, $1,200. Again, this is the 17th. And the cost of the sale, cost of goods sold, was $730. Credit inventory, $730. That's the 17th. Okay. We're now at the 20th, on 6/20. What happens on 6/20? Purchase books on account for $720 from priceless book purchases, terms 115 net 30, 1% discount if paid within 15 days. That's the 20th. So we're going to debit inventory, $720, credit accounts payable, the $720. 624, received payment in full from Bell Tower. So if we look back at Bell Tower, the Bell Tower transaction occurred on the 17th. They sold books on account to Bell Tower for $1,200. Cost of merchandise was $730. So they sold it for $1,200. But when we go back to the beginning of the problem, it says Powell Warehouse distributes hardback books to retail stores and extends credit terms of 210 net 30. So they give a discount to their customers, 210 net 30, if they pay within 10 days. When did they sell the books initially? They sold them on the 17th. They're paying for them on the 24th. That's 7 days. That's within the discount period. So you say to yourself, well, I'm not quite sure what the cash going out the door is, but let's put down what we know. So we know we're going to have a credit to accounts receivable for $1,200. And we also know that there's going to be a sales discount. But for how much? Well, it's the $1,200 times 2%. 1,200 times 2% is $24. So we have a debit to sales discounts for $24. Well, the amount of cash that they receive, 1,200 minus the $24, is $1,176. So they're receiving $1,176 from their customer. The original receivable was $1,200. On 626, received payment in full from, paid priceless book publishers in full. So they paid them. So what was their discount? Okay, paid priceless. So they had one N115, right? So if they paid it within 15 days, they get a 1% discount. So they originally owed them how much? They originally owed them $720. And they're going to get a 1% discount. This is $7.20. So the discount, $720 times 1%, not 10%. 10% would be $72. 1%, $7.20. So that's the discount. So they're going to get rid of their accounts payable for the full amount. The accounts payable is going to be reduced by $720. They're going to have a reduction in inventory for the discount, which is the $7.20. And they're going to pay them $720 less the $7.20, $712.80. You only owe them cash is $712.80. Let's take a look at the 28th. This is 6/28. On the 28th, sold books on account to general bookstore for $1,300. The cost of merchandise was $780. So again, pretty straightforward. We've seen a few of these debit accounts receivable, credit sales revenue for the amount of the revenue, $1,300. More importantly, cost of goods sold, credit inventory, right? For the cost, which they said the cost was $780. And then lastly, on 6/30, granted general bookstore $130, credit for the books returned costing $80. So we have a sales return for the amount of the sale, credit accounts receivable, and we got to put back in inventory at its cost, which was $80, credit to cost of goods sold, $80. Okay, I know you can't quite see that, it's a little off. So those are the journal entries. It asked you to journalize for the month. That's problem 5-2A. Lastly, let's take a look at problem 5-7A. Let's read it. At the end of Oates Department Store's fiscal year of November 30th, these accounts appeared in its adjusted trial balance. Bunch of accounts. Inventory on November 30th, the end of the month, $36,200. Note that Oates Department Store uses the periodic system, right? Periodic. Means they do not keep track of inventory on a perpetual basis. They only calculate cost of goods sold at the end of the accounting period. Now you remember that formula, beginning inventory plus purchases minus cost of goods sold equals ending inventory. So we have a beginning inventory here. Beginning inventory says that it is exactly $41,300. And now we want to look at purchases. So we had purchases of $613,000. But we had discounts, purchase discounts, which reduce, brackets means negative number, by $7,000. They also had some returns of $67.60. And they had some freight that they paid for, right? Freight in, they paid $5,060. That increases inventory. So purchases, cost of purchases, the 41.3 plus, cost of purchases less discounts, less returns, plus freight in was a total of 6,043. Goods available for sale. $41.3 plus 6,043, 645.6. Less ending inventory. And they told you the ending inventory was $36,200. Goods available for sale minus ending inventory equals cost of goods sold. In this case, 6,094. $609,400. And as I mentioned earlier, another way to look at this is that beginning inventory plus cost of goods purchased equals goods available for sale, which also equals I'll do it one more time, CGS plus ending inventory. So in this case, it's $41,300 plus cost of goods purchased, 6,043 equals 645.6, which also equals what? 6,094 plus my ending inventory of $36,200. You keep it simple. Beginning inventory plus purchases equals goods available, which equals CGS plus ending inventory. Should always work out. So those are the problems from chapter 5. Good luck and thank you.